Hi everyone, so last year I made a video called How to Start a Growth Portfolio, and if you had invested in that exact portfolio in October when I released the video, which consisted of Bank of America, Berkshire Hathaway, Prudential Financial and Biogen, you would already have almost 50% gain in just about 7 months. Now today I'm going to take the same approach for those who are looking to build a growth portfolio. It won't be any of the same companies because prices have changed and the opportunities have changed as well. So if you are wanting to start investing and don't mind riding the ups and downs of the stock market, well, that's what this video is all about. I'll give you 3 stocks that I would build a new portfolio around by the end of this video. So like I said, my last edition of this video was about 7 months ago, and I have definitely changed my thinking regarding investing. I'm looking for smaller companies now that have long runways and big upside with minimal downside. The companies that I suggested in the last video are still solid companies and have room to grow, but the prices have moved quite a lot. So Bank of America has gone from $24 to $42. Berkshire Hathaway, the B-class shares, have gone from about $200 to $290. Prudential Financial has gone from about $63 to $105. And Biogen hasn't moved as much, from $250 to about $270 now. So I think there is still room for all of these stocks to grow further, and it is probably best to hold these and forget about them if you don't feel like doing the research into new companies. Biogen would be the only exception here, as I have decided that the pharmaceutical industry is just too hard for me to understand. And look, there's just a lot I don't know. So I wouldn't have Biogen in this list anymore, but the other 3 I'm much more confident with. But I've actually learned a lot over the last 7 months, and I've changed my thinking about how I want to invest in companies into the future. So these companies unfortunately have a few problems that don't fit my new ideas. So the issues I have with these companies are: 1, they're just too big. The market caps are way past the billion-dollar mark that I'm preferring. Number 2, well, the prices have moved closer to fair value, and a lot of the price movement has happened that I was looking for. It happened very quickly, which is great, but I don't expect 50% to repeat, as that would push prices past their fair value. And 3, I seriously want market-beating returns, and I won't get that with these companies now because those prices have moved. So the strategy would be different today. I would look for small caps, because it's easier for a $500 million company to become $50 billion rather than a $1 trillion company getting to $100 trillion. The law of large numbers will make a bit of a difference here. The second thing I'm looking for are long runways, so companies that I think will grow significantly over the next 10 to 20 years. And the third thing I'm looking for is great historical performance. So no IPO stocks or negative free cash flow stocks or anything like that. That's the same as always. Okay, so let's now take a look at the first stock that I would start with today. Okay, so we're starting in Japan with Shinniken. Now, Shinniken develops apartment projects, sells the apartments, and also acts as a property manager as well. The market size for Shinniken is gigantic. Tokyo is the biggest city on the planet, and the fact that Shinniken is only representing about 1% of all the new apartments in Japan, there is just a very big market to grow into. Their market cap is under $400 million US, so they are a small cap company in a big marketplace. The company has some really interesting growth plans for the future as well. They are launching a REIT in Indonesia to raise money for further expansion. They will continue growing their management side of their business each time they sell one of their apartments, and they can easily expand further into Japanese cities and throughout Tokyo. Japan has 125 million people and is the world's 3rd largest economy. But definitely the biggest reason why I'm investing in Shinniken is Monish Pabrai, one of my favorite authors and investors, has recently invested in Shinniken, and it appears he holds more than 5% of the company now. The CEO himself is also heavily invested in the stock, which aligns his incentives with those of shareholders. Now, I think the price somewhere under 1,800 yen is a pretty decent deal, mostly because historic book value and compounding rates have been historically very good. Therefore, they'll return to these levels hopefully, and this will make a great investment. Shinniken has a lot of signs of a long-term compounder, and I would just lock this one away until Monish Pabrai sells it. Now, before I get into stock number 2, for those who want the safest brokerage account for buying shares in Shinniken and many other companies as well, I have a link in my description to Interactive Brokers, where you will get a free Interactive Brokers stock, I think up to like $200 for signing up and using the platform. Look, this is far better than Robinhood or anything else like that, because Interactive Brokers have like decades of experience, a strong balance sheet, and an extremely solid, trusted business. They also serve people in most countries throughout the world. So if you're in Germany or Japan or Spain or even the Ukraine, you can get an account. I personally have an account with them. So OTCM, which stands for over-the-counter markets, essentially are a coordinator of tens of thousands of company listings. They compete with the NASDAQ and the New York Stock Exchange, but in the small cap world, and they also list international listings. They have a different market, I think, entirely to the NASDAQ and the New York Stock Exchange. The small cap world is underserved and OTCM is the only player. Sometimes when you go to like Yahoo Finance and you look for a company's stock ticker, it'll tell you that it's on the NASDAQ, the New York Stock Exchange, or something like the OTCM markets or the pink sheet markets. That stuff is all run by OTCM. And the path of growth is relatively simple. New companies are always going to be created. I believe entrepreneurship is alive and well and will continue into the future. They have pricing power. Being a near monopoly, they can increase prices and not lose customers. They've actually done this in the last 6 months and has only made the business more money with very minimal turnover. The third thing they can do is they have international expansion opportunities. Look, the world is just full of companies wanting to access US investors. And their fourth way to grow is, well, it's a subscription business model which helps compound the business and add downside protection. They have over 90% customer retention rates. So as they get more customers, it just builds onto that base. They have a very long history, so you can go back a long way to feel comfortable. You can actually go back multiple decades. Also, they have consistent gross margins over 90%. And the return on invested capital for the past 10 years, well, look, this is extraordinarily impressive. These are decade-long numbers, and this is just a great compounder. Now, regarding debt, well, it's small. CapEx is consistently tiny. And when you get to the cash flow statement, you will see that operating cash flows turns nearly entirely into free cash flow. And free cash flow is growing on average at about 15% per annum for now a decade. It's a little lumpy, but it's really good growth. Cash in the bank keeps growing as well. The CEO, Cromwell Coulson, holds 36% of the company, so his incentives are heavily aligned with ours. And institutions haven't discovered this yet, with only 6% institutional ownership. Regarding price though, well, price to free cash flow is about 19. Look, not a crazy bargain, but not overpriced either. You can do your own DCF or whatever method you like, you'll see it's not too bad. If it ever gets under $30, in my opinion, that's a bargain. But starting to buy even at $40 probably isn't a bad deal. The downside is minimal with the recurring revenue streams that they have, the market tailwinds that they have as well, and they're just making a lot of money and highly profitable. But the upside is what makes this investment special in my eyes. Being at only $500 million, the upside will hopefully just take care of itself. There is a problem though, and that is that no one else has invested in it. I would love a super investor to invest in the company just to reassure me that I'm not missing something obvious. Now, everything that I say here is just my own opinion. It's not advice. It's all just entertainment purposes. I'm not going to come to you and ask you for a cut when you double your money. So don't complain to me if the price crashes and you lose your money. These videos are essentially just a place for me to put my ideas somewhere in an easy format so I can watch them again in the future. Okay, I actually got stuck here thinking of a third stock, so I'll give you a list of some of my options. They all have their own pros and cons. So the first company I was thinking about was Markel, because they have long-term owner-friendly managers, profitable, conservative insurance operations. They're stable, reliable, and a diversified portfolio of assets under their management, and a price at around $1,200 is a good deal. But the cons are, look, there's not massive growth here, maybe 10-15% per annum. It's still pretty good, but it's not amazing. And they're already at about $17 billion in market cap. Well, in my opinion, this is a great, reliable business that will help you sleep at night if you're someone who worries about their investments. Then I was thinking about Judges Scientific. The pros are, well, their growth rates have been impressive, about 16% average ROIC over a decade now. They're a small cap company at only $400 million. They are disciplined acquirers of businesses, allowing for multiple revenue streams, and the CEO is highly invested. The cons are, well, the price is too high in my opinion. 5,000 pence is my first entry level that I would feel better starting at, but it really needs to be under 4,000 pence before I get really serious. At the moment, I think it's about 6,000. Then I was thinking about Etsy. They have a lot of pros. E-commerce is a safe, fast-growing industry. They have great compounding metrics. That ROIC percentage of theirs is very good. Network effect businesses get more efficient and more profitable as they grow, and I love network effect businesses. They're very profitable, gross margins and free cash flow numbers are really strong. 2020 was just an incredible year. It is like it's 2023 for Etsy, that's what the CEO said. The addressable market is big, plus advertising on the platform is only just getting started, and the price, well, it isn't crazy high. I think at about $150 is where I would feel comfortable investing. At $120, I'm going to be buying a lot. But they do have some cons. The CEO is not a founder, and this isn't a deal breaker, but I do prefer founder CEOs. Unfortunately, no super investors I like have invested in the company either. Their debt levels are a little high. Look, everything currently says debt is totally manageable and their debt that they got is cheap. I just hate debt. They don't need it. I hope they pay it down real fast. And their market cap is bigger than I prefer. I'm looking for $1 billion companies and less, and Etsy at about $25 billion is already pretty big. Now, I could probably throw Nintendo and Constellation Software into this list as well. I have videos on all these companies that I am mentioning, by the way, if you want to see my deeper dive into these. I'm also looking into a company called REDBUBBLE, an Australian-based company which is kind of similar to Etsy, but I haven't finished digging into that one yet. Now, I have to be very careful of commitment bias. I have announced to the world these are the stocks I would want to start a portfolio with, but I need to be okay to change my mind if I learn something new or something changes in the thesis. I don't want to hold these companies just because I said they are good investments. I have to be able to look at each of my investments honestly and subjectively at all times. So something to be really careful of is commitment bias on YouTube and in your own portfolio. I mean, I have friends who love cryptocurrency. They have strong opinions on it, they are heavily invested, they're always talking about it, but this means they're very likely going to hang on even if it isn't a logical investment anymore. They have put too much of their reputation on the line to be wrong. So I'll happily say that I might be wrong with all of these investments. I'm trying very hard not to be wrong, but I might be. And if I am wrong, hopefully I can find that out quickly. So my plan is to hold on to these investments like Shinnikin, OTCM, and the others for decades if I can. And that is the true test of a good investor. So I want to have the ability to honestly critique each investment, not be influenced by the many different biases, and hopefully be able to choose and hold investments where the thesis doesn't change too much. But if I am wrong, I can sell and move on without being scared of letting everyone down. Having a financial YouTube channel like mine has a lot of positives, but look, this is the biggest negative. Hopefully this video has motivated you to get researching yourself, and I'll have more content like this in the future. Give this video a like if you get something out of it, and I will see you in the next video.